If you look at the market on a day by day basis between the 9:30 opening bell to 11 o'clock in the morning, always Eastern time, and from a 1 minute perspective, considering the market structure and all of the ebb and flow that's seen on the 1 minute chart, there's a lot of things that are going on inside that 1 minute chart that people can't see. They don't have any understanding of what's going on. And even if you're not someone that's equipped or even inspired to look at those lower time frames because you've seen other people say they're noise or they're too choppy or they're just useless information, that to me is a dumbass cop out because what's the difference between whether you're watching that price fluctuation on a 5 second chart, 1 second chart, tick chart, 15-minute chart, 51-minute chart, hourly chart? Isn't the same fluctuation from tick to tick the same thing, whether you're looking at it from one time frame to the next? Is the market somehow different? I'm asking, I'm not doing it rhetorical, I'm asking you.
No, no, it's fractal
It's the same, it's the
delivery.
same
That
price.
yes, it's fractal delivery.
It's the same price that's being delivered the same way. But when we look at it from a very short time frame, like sub 1 minute, the perspective that the algorithms are referring to, because they're not just keying up on a 15-minute this and that or an hourly this or that. They're in there firing all day long, buying and selling, buying and selling, buying and selling. And they're trying to capture fluctuations in disparities between price. So if we go in, not under the guise of I'm going to try to take every potential trade that's available to me. That's not what I'm not trying to inspire that. But what I am trying to tell you is if you spend time between 9 o'clock, I'm sorry, 9:30 in the morning opening time for equities to 11 o'clock, it's a very static 90-minute time period. It's not a cycle. It's just a very static portion of price action for the intraday range. If you spend time looking at that and you look for relative equal lows when you're bullish, see them on a 15-second chart. Note when they form. As soon as they form, note the time that it does that. And then how long does it run away above those before it starts to come back down? And when does it run those relative equal lows? By keeping a journal of when those things occur, you're going to start seeing an overlapping of a very specific element that I'm not going to come out and say, here it is, but you will see it. You will see it, it's undeniable, and you will see why I've waited on these live streams and when I'm broadcasting and calling candlestick by candlestick, why I'm not referring to any specific candle that you're questioning me about. It'll be obvious and it will help you understand why the daily candle is creating the lows, the short-term lows, why 1 minute candles get ignored, why fair value gaps stay open, why are other candles more salient to others on a 1 minute, 2 minute, 3 minute, 4 minute, 5 minute basis. Why am I only looking at that one? Because you're going to get the answer inside that 15-second chart. You can still see it on a 30-second chart, but as I mentioned in the presentation, but I'm not sure if it was coming across clear or not. I personally use the 15-second chart for that purpose. So when I'm talking and calling candlestick by candlestick, when I'm doing it in Telegram or when I was doing it on X, I have that 15-second chart in front of me. My phone, I'm putting the information out in public eye through that medium, but I have all of my monitors, showing me all the time frames I'm looking for with all the pertinent information I'm watching, but I'm watching that 15-second chart because I'm understanding that if I'm bullish, my bias is bullish, I know that I only want to be looking for price runs that's going to happen after a sell stop raid. That's like rocket fuel. It's like pouring gasoline on a fire. And when you want to see the real secrets behind what it is I'm doing, when they're like, wow, how did you know it did that? When I'm calling out there publicly, read the comments. They're like, how did you know that? I taught that today. I'm showing you what it is I'm doing. And when I'm bearish, I'm the same thing I'm doing. I'm looking for 15-second relative equal highs. When they run up and bump that, and I'm bearish, I'm waiting for everything I teach you to unfold there and then work its way into the 1 minute chart. And then that 1 minute chart works its way into a 5 minute chart. And all of the order flow, the price continuum delivery is seen from time frame from 15-second up. Then you get the daily candle delivery as it should be. But as a real foundation to understanding why a daily range forms and ways that it forms, like why does it go down to a specific low? Why did you expect that low and not this one? The rules I gave, were based on economic calendar. They were based on pools of liquidity that cannot be hidden from you. Asian session lows when you're bullish, they're going to go down there when it's a high impact news driver, usually at 9:45 Eastern time or the 10 o'clock news drivers. They really want to wash those individuals out. And they know, especially if the market's rallied from Asia's open at 6 o'clock in the afternoon or evening time, Eastern time, local time, which essentially is the same thing as a restart in equities or index futures at 6 p.m. Eastern time after our 1 hour break. If we see that the market has gone like a 45-degree angle or just continuously moving higher from that period of time, but you have a 9:45 or a 10 o'clock news impact that's going to be high red folder, not medium impact. It's got to be high red folder news. If that occurs, then I'm anticipating those Asian lows, if they're relatively equal, they're going to come all the way down there for them. I'm looking for that. Now, when we use the London lows, a medium impact driver can see that happen. When I'm bullish, I'm looking for the lows below London to be washed out before the price rallies up when I'm bullish. Any other time, any other instance, okay, is when there is no news driver, they can still take it down to London. But it's based on where you're at in the premium to discount portion of the range of where you think the market's going to go to. So as a case study, as an example here, let's say it's Monday's trading and it's 7 o'clock in the morning and there's an absence of any kind of news on a Monday. But we are in the discount portion of a range that you think is going to deliver over the course of 300 to 400 handles. And I'm not saying that number of handles is essential to this being true or not. It just means that whatever your weekly objective is, where you think the weekly range, one single candle for the week, is going to go up to or go down to. In this case, if it's bullish, there's no news on that Monday. I still would anticipate London lows being taken out, especially if they're relatively equal. If I'm bullish, if I'm bearish, I would expect London relative equal highs to be rallied up to, and then the real move comes. So when you have the pre-market session between 7 o'clock in the morning to 9:30 in the morning, okay, those are generally every session always a potential. So without saying, I mean, if it's going to go to London lows or if it's going to go to Asia's lows, it's going to go to the pre-market session lows, right? I mean, that goes without saying. But when do I limit my understanding about entering that trade? What's the green light go to only focusing on whatever the liquidity is that's formed at 7 o'clock or after? It's when I'm in the upper portion of the price run that I think is going to be delivered for the weekly range. So if you understand discount to premium as I teach it, there's very little retracements as you get into the premium side of a price run. So if you know what you're looking for, you're not going to have deep retracements in the upper half because they're not going to allow retail Rick, as I mentioned today, to get a deep discount. They're not going to give them the opportunity to get in. So it's going to have them feeling like they have to chase price. And for people that are disciplined, they let those price runs go because they feel like they're chasing price. In the delivery, when it's below equilibrium of whatever that price run is you think. So what starts the move and what ends the move in a perfect world for the weekly raid on buy side or trading to an inefficiency that's in premium. Whatever that range is that you define for your weekly objective, like I framed it based on what I showed you this week. Once it hit it, I was not interested. Even if non-farm payroll wasn't a factor this week, I would not have traded on Friday because what I opened up the week with wanting to see it delivered to, it delivered. So I have to have boundaries. I have to know this is as far as I'm willing to go in there in this current climate. So knowing which pool of liquidity you're going to be aiming for and why is essential, and it's crucial to be trading with the current present narrative. Knowing how far it's going to go down when you're bullish before it goes higher. Because all of the cleanest price runs, the most ferocious, the most explosive type sustained price runs, always, 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 without fail, will happen after an opposing liquidity raid. When you're bullish, sell stops will be rated, and then it runs. When you're bearish, buy stops will be rated before it drops and runs. So when you can bring all these ingredients together, where your higher time frame weekly chart, you're really bullish, you think it's going to go to an objective. I've been teaching that since I've been teaching as a mentor, how to determine that. But the confusion is where students and traders that come into my listening range, they say that I complicate everything and just tell me the bias. What's the easy way about bias is easy. Are you bullish or bearish? And you just anchor to a weekly chart based on what you think it's going to do there. That's an easy thing, but that doesn't translate to knowing how you're going to work with that bias intraday. And that's why you get the Goldman Sachs boys that come out there and they'll say, anything, anybody tells you to trade their 1 minute chart, run away from them because they're con artists. Nobody can do it consistently. Nobody. And here we are, a community that consistently fucking does it. So they want to ignore that. They want to pretend it's not there. But I'm telling you, focus on these things, okay? Because like I've done all the time as a mentor, I'm not telling you something just to believe it because I said so. My whole reputation has been built on the fact that this is what I'm telling you to go do. And you will see that in the price action. You will see the evidence. You will find it in your own hands, and it's undeniable. It doesn't matter what anybody else says about it. If you see it happening over and over and over again, is someone going to change your mind about what it is you're seeing? Fuck no, they're not going to change anything. You can see it. Once you have that underneath you as experience, no one's going to tell you that it didn't happen, that you've been watching it for months and years and you're able to make money off of it. Someone's going to argue and tell you that you've been using the same logic to nail down the low of the day and then ride that son of a bitch all the way up into the afternoon. And then the benefits of understanding that 2 hour window between 11:30 in the morning to 1:30 in the morning, 1:30 in the afternoon Eastern time, that 2 hour lunch period, knowing that if you're bullish, then all we're going to do is look for the low that formed at 10 o'clock Eastern time going into where we had traded for that 2 hour period. During that 2 hour period, it's going to come down and blow out that 10 o'clock low. That's the lunch macro. That's exactly what it does. That's why it's there. It goes down to do what? To unseat those individuals that were fortunate enough to get in, but also too aggressive by trailing their stop loss right up to that low at 10 o'clock or the low that forms after 10 o'clock. That's why I tell you that New York lunch window, whatever that 10 o'clock low is when you've been bullish, whether it's going to reverse that day and go lower or if it's going down to take the stops, that is an easy trade. It's an intraday contrarian setup. So if you have a contrarian perspective, if you're someone that's contrarian, that's just like to go against the grain, miss the initial move of the day in the morning. Miss it. Intentionally miss it. And then at 11:30, start anticipating a drop down into the low that formed after 10 o'clock. And you will have an 85% likelihood of finding bread every single fucking day. And you don't have to be in the portion of the biggest part of the day. You don't have to be right about this or that. It's easy. How do you get into it? A silver bullet, 1 minute chart, 30-second chart, 15-second chart. They're there every fucking day. They're flawless. Zero instances where it does not form. It's there every fucking day, every day, every day. But the one, as I mentioned this morning, where it's a trending day where it blasts off and it just does not come back. It just keeps going and going and going and going and going. Those days, unless I'm pre-session, in there already, I'm missing those days. I'm missing it, which is the reason why I teach you to spend some time in that 7 o'clock and 9:30, because if you get real comfortable trading pre-market session, those tigers never slip out of your hands. You can grab a hold of their tail, and when they blast off at the opening bell, and it doesn't even worry about the opening range, it doesn't even worry about first presented fair value gap, it doesn't even worry about silver bullet 10 o'clock, it just keeps tearing people's face off, keeps going higher, 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 higher. The only way you can participate in that is to chase price, which is completely alien to what we do, or learn how to be positioned between 7 o'clock and 9:30. Pay yourself a little bit, roll a stop to something, so if it stops out, who cares? You get a nice dinner, paid to you for your participation, and just let it go. Let it develop. If you don't spend time with trying to formulate a long-term bias where it's likely to go to, you're never going to get these monstrosities of windfall profits. Those will never happen for you. They don't just happen consistently by blind luck. The people that do the time in charting and looking for these weekly charts or the daily chart that has a sizable swing objective above or below, those are the traders that are preparing themselves to see that. But then you have to do a lot of other things, which is weigh out what liquidity is going to go for. Well, without the economic calendar and an understanding of where you're at in that range of the implied delivery of that range of objective you're reaching for, that range between where you're at right now and where it gets to, that's an implied dealing range. It's not there in the chart yet, but you have to be able to see it as if it's going to be there. And then where you think it's going is terminus. At the end, that's the best case exit strategy for you. Measure that. If you're in the lower half of that when you're bullish, all the things I mentioned about the London low and the Asian low are true. But as soon as you breach equilibrium of that implied dealing range of where you think the move's already underway, okay, it's already, say it's like Wednesday or Thursday, you're going to see less likely for London low and or especially Asia's low being swept before it rallies again. Any other day, I'm looking for the liquidity at 7 o'clock in the morning to present 9:30 opening. That's like if you're just going to look for a very obvious pool of liquidity that's going to aim for just about almost every single day, it's that liquidity between 7 o'clock in the morning and 9:30. Just study it. Don't take my word for it. Don't listen to me and say, well, there it is. That's the gospel. ICT said it, so therefore I ain't got a balloon where you go and back test any of it. No, take what I said as a guideline and say, okay, I'm going to look at the Nasdaq or the S&P or the Dow. I don't like the Dow, but you pick your index and go through it. If you're a Forex trader, it's the same logic, folks. It doesn't change because it's no longer index futures. It's the same thing I was doing with Forex. The problem is Forex is kind of sleepy right now. It has its one little hit wonder, but everything else is like it's cloudy. It's not worth my time trading the ranges.